Hello, everyone. Welcome to Lumber Futures from the Free Seats. Today, I am actually working by myself. Greg Kuda is doing his civic duty of civic jury duty. And Kip has the unfortunate, he has to put his dog down today. But nonetheless, still going to have a great show here. So without further ado, I am going to kick it off. Let's share this screen. So here we are, Lumber Futures from the Free Seats. And I'm going to get up here. So news out today was existing home sales. And there was a surge according to this, surge in existing home sales. It snaps the record decline. And, we can see, I'll show you a chart a little bit later. Since the beginning of the year, home sales have been declining. And the interesting thing I saw about this data, though, was the median selling price of previously owned homes has also fallen 0.2% from a year earlier to $363,000. First decline in 11 years. There's no doubt it's more expensive to buy a home, because of the cost of money. So not too surprising. A person's ability to pay for a house is a reflection of how much of a monthly mortgage they can, unless they're a cash buyer, of course, monthly mortgage that they can afford to pay. I think what you're seeing here, in my opinion, is maybe just a little bit of the concept that mortgage rates could be stabilizing. That could have caused this. But let's jump to the next slide. And here we go. Let's talk about mortgage rates. If we back up one. So from the beginning of the year down, existing homes were declining, home sales. And if you look basically from the beginning of the year, mortgage rates started going up. Here you have mortgage rates falling into the end of the year. Go back here, and you can see there was, maybe a little blip here at the end of the year where new home or existing home sales picked up. But look, you don't have to tell anybody, mortgage rates matter. So what's going on with mortgage rates? We all know about the banking crisis, of course. And we talked about this a little bit last week, where there is a flight to safety when these banks were starting to blow up. The people were piling into treasury notes, and it was dropping interest rates. So what you see here right at the end, there's a little blip of where actually this is showing mortgage rates going up. But here you can see the mortgage rates had gone down pretty steadily. Now, what I find interesting, though, is we're nowhere near back where we were at the beginning of February. So at the beginning of February, we saw this, mortgage rates pull back. Not surprising, existing home sales went up. So even with all this banking issues going on, I expected mortgage rates to come down a little stronger. Maybe it's just going to take some time to bleed through. But for sure, if we see a stabilization in mortgage rates, much better opportunity for home sales to pick up. So we'll jump into lumber here. What's going on in open interest? So we're looking at the legacy contract. This is first thing about the futures kind of cycle that we're in right now. March just went off the board. It settled at 347. May settled yesterday at 444. $100 spread between where March settled and where May's trading. The prices that we're talking about for lumber futures today, this is wood being priced for delivery near the end of May. This is wood that's probably going to hit people's yards in June. So essentially, this is wood for July. This is Q3 wood. So here we are at the end of Q1, and we're basically talking about Q3 pricing. So I think it's really important to understand the dislocation between where the futures price is and the cash price. This is as dislocated as the front month can be from the futures price. They're two different animals. But let's just take a look at the open interest. It's continuing to fall here in May. It's continuing to grow in the new contract, the truckload contract. So while it's not, this is a 4-to-1 ratio. So theoretically, if this is 1,500, what we should see is about 6,000 up here. And I think you're going to see a big jump in that over the next, obviously over the next 2 months. All right. And then options, not much to say about options. They just aren't trading yet. As we see the open interest in the new contract pick up, you'll see the option, the activity in options pick up. The commitment of traders report. This is my favorite, and we're catching up. We're on at March 7th. So I would think by this Friday, we should be totally caught up, and we will probably get the report from, well, I guess we're missing the 14th and then the 21st. Hopefully we get the 21st this Friday. But the big number is right here. This, managed money is now short 1,327 contracts as of 2 weeks ago. That is 2/3 of all the open interest. That's a big deal. We know that managed money is not going to be taking delivery. So this 1,300 is either going to get rolled into the next contract, or it's going to get covered. If it's a massive short covering, then there's that possibility we get a short squeeze. But the flip side is that the short open interest from the industry is 245. It's a ridiculously low number. And look at this big drop, 275. It kind of makes sense when you go back and we'll look at the chart. Actually, why don't we jump ahead and look at the chart? So this was as of March 7th, which puts us right here. And what you can see is that there was a big covering. The shorts covered their positions. So going back up here, what I could see happen is as these managed money starts to buy back their position, the industry will step in and sell into that. So the response could be muted. I think it could start out pretty strong, but this is just one of those, it's a known that this is going to happen. So I easily could see where the industry would step in and sell it, especially with where the cash market is compared to where the futures prices are. So my contacts in the field told me today the cash price, FOB, the mills in British Columbia, is around 385. Futures is trading 445. So there's a $60 difference. If futures continues to move higher, cash stays the same, the basis opportunity just becomes even that better. That's basically what I'm seeing here. And once again, I can't stress enough, this is from March 7th. So there could be obviously difference between, we got a 2-week lag until we get the data from this Friday, which should be from the 21st. All right, so moving to the charts. What do I see in the charts? Greg Riley put out today or yesterday on LinkedIn, he's looking at a range trade for 2023, between mid 360s to mid to low 500s. I get where he's coming from. I do believe this chart shows that we've established a low trading range, a low trading price. And it's that high 300s. So just below 400. Now, the prices we're talking here are all legacy contract, of course. Remember this. This is all railcar loaded British Columbia in Prince George, British Columbia. To equate this to the new contract, what you really need to do is add in around 110, give or take a little bit. So, I'm just going to say that the low trade price is really 480 in the new contract. So when you're just thinking of the new contract, but on the long term, what I see is we've got a pretty substantial double top up here around that 550, I should say. And even above that, we've got these old highs, which those should be pretty good resistance. Now let's dial in a little bit here to what's happening in the very recent. Okay. So the rally from the beginning of January into, and then, by the way, this peaked on February 1st. This was a short covering rally. This is when the funds were exiting their position. And I think it caught a lot of people by surprise, especially this move from in late January, where it really raced quite a bit higher. And there was an incredible basis opportunity right at the end of January. So then things kind of calmed down. And unfortunately, we had the issue that we couldn't see the commitment of traders report. But from January 1st, so basically the first 3 weeks, February 1st, the first 3 weeks of February, straight down. In fact, it was almost higher or lower lows every day. The funds went in and they got short again. So they're covering their position here. They reestablished a short position to here. It's starting to look awfully similar in this setup to the setup that we had at the beginning of the year, the end of 2022, the beginning of January. And, this is an extremely consistent pattern they call the flag pattern, so starting here in January, the market moves higher and then it drifts sideways just a little bit lower, and there just isn't enough selling going on, and then it pops out of there. So there's an argument that could be made that we're starting to develop a flag pattern right here. There's an argument to be made that the industry or the funds managed money is short, and a short covering could pop out of here. I look at this and I say, we were racing towards the lows and bounced off the bottom, we had a bit of a bounce, turned over, and we couldn't take out this low. So now we've got higher lows. So all in, it would be fairly easy to project higher. So if we're going to project this market going higher, what are some of the tools at our disposal? I like to look at Fibonacci retracements, and lumber has shown me over time it loves a 50% retracement. It just loves to go halfway back on a move. So we basically hit the 50% retracement yesterday, and then traded off quite quickly. It seemed as though as soon as it looked like there was some fun buying in there, as soon as the fun buying went away, the market collapsed for the day, that is. We haven't reestablished that buying really yet today. We're essentially unchanged. So the next thing I start to look for are the 661.8 Fibonacci, which is up here just above 480. The interesting thing I see there is the 61.8 corresponds exactly with a gap in the chart. Once again, the market loves to go fill gaps, especially lumber. Lumber loves gaps. So I could see us forming a pennant, starting to break out, fill this gap at the 61.8. Then If there is the momentum, which I could easily see there be momentum, we have another gap here. Tops out at around what is that, about 510? And essentially there, now you're back at the top of this range. So, everything's set up for this market to go higher from a technical standpoint. Now we got to look at what happens if that doesn't. So we also could see this flag look like it start to develop, the market to rally up back to 50%, double top, and then the target is back to the lows. If we break this trend line, I easily could see us heading back down into the 380, 360 mark. So fundamentally, what has to happen for these things to occur? For us to rally, demand definitely has to pick up. I could see it happening with mortgage rates, stabilizing or even coming down. We know that there is inherent demand in the market, that the industry's underbuilt. We need more houses. Sure. So there's an argument for demand. But if in the short term here, demand does not develop, does not come up, or doesn't present itself, and supply does nothing to change itself, meaning the wood just keeps coming, there's no reason why we can't drive the market back down to the lows. So I feel like we're at a bit of a crossroads here. It's the middle of the range. There's an old trading adage, don't diddle in the middle. And the way the market acted here in March so far, it was very indecisive, higher, lower. This is a very much a sideways pattern. I'm sitting here I guess my lean is probably to the higher, moving higher, just because of the funds. But if I could also just see the funds coming in and buying back their shorts, but industry absorbing it. Because, hey, at the end of the day, 460 is a great number. 470 is a great number. I'll give you, costs are higher, unequivocal, but they're making money at these prices. I think the Europeans, they're not excited about those prices. They work for them because there's nowhere else in the world to really go with their wood. So all in, I'm kind of sitting back going, show me. I need the market to show me what it really wants to do. Okay. The last thing I want to cover is basis trading. And I've been talking to Kip. Actually, this morning I talked to Kip. Was talking with Greg about it this week. Why are people not basis trading more? And I think part of it has to do with this concept of cost to carry. And I don't really want to, my goal is not to preach here, of course. It's more just to discuss some of the things to consider in that cost to carry. And it's really important that when you're looking at a basis trade, that you understand all of the input costs, so you can understand the real opportunity. Because all of a sudden you can put the basis trade on and buy cash, sell cash in and out of your futures and have not made any money, and you're like, what happened? So the factors, interest rates. Obviously, in today's market, interest rates are a negative for cost, or they add to the cost to carry. They're a negative for the basis trade, and it's definitely has to be factored in. What is it? Are you going to figure 1% a month? Ends up being 3% if you have to hold a basis trade for 3 months. That starts to definitely eat you pay $400 or $500 for your wood. There's $15 a thousand right there that is just taken away in interest rates. So if your basis is $60, now you're down to $45. reloading charges. The reality is you're going to get a car or truck of wood, and it has to sit somewhere. So you can pay a third party, of course, to do your reloading for you. You can do it. You can internalize that. It's a cost. So reloading charges, I think, have gone up a bit. We could say it's somewhere between 5 and 10. So now you're at 20 to 25. Storage charges, and these are a big deal as well, depending on where you're at. They can add in if you're using public storage. This is kind of the next one, cash for margin requirement. This is the unknown of it. When we're at the levels in the kind of the spectrum of prices where we're at right now, we easily could see these prices double. We could go from 400 to 800, which now you're sitting here going, well, that's fantastic. And it is for your cash position. But the CME group is going to require you to margin up. You're going to have a substantial loss in your futures account that you have to margin up. And $400 on 4 trucks or a car is $40,000. So now all of a sudden you have ratcheted up your interest rate charges as well. Let's say you have a 10 cars basis traded on in a basis, and your margin goes up by $400,000. That's pretty significant. Lastly, the opportunity cost of capital. So when interest rates are where they're at, let's just say you're not borrowing money, you have the cash. You could just put that money in the bank. You could and get 4%. So everybody's situation is very different. But going into this with eyes wide open, going into a basis trade with eyes wide open, really understanding your cost to carry, and maybe it's lower than you think. Maybe there's ways that you can reduce this. I think one of the hidden benefits of a basis trade that gets overlooked is the opportunity to have, it's a little bit of a rob Peter to pay Paul. You have a pile of wood sitting there that you're not supposed to touch. But if you can sell that and repurchase it for a profit, you lower your cost basis on that wood. So if your cost basis is $500, you end up selling 4 trucks, you make $20 1,000, you replace them. Now you've just, with a $20 profit in there, you've reduced your cost, your holding cost. So I guess what I'm encouraging everyone to do who's ever interested in basis trading is know your cost to carry. All right. So with that, Matt Lehman just made a comment here, and his comment, my guys had a hard time unloading the cash on the last basis, need the big discount to sell it. And absolutely, not factored into the cost of carry is actually what is the exit cost? What is the cost of liquidity? How much am I going to have to discount to get out of my position? And Matt's spot on with that. You definitely, in a basis trade, you want to make sure that you have an easy to exit position. If you're holding the wood nobody wants, it's hard to get rid of, and it's going to cost you. This is what it comes down to. All right. So with that, we'll wrap it up. Next week, everyone will be back, and hopefully we'll have the CFTC numbers that we can take a good look at. But I think I hate to be wishy-washy about the market here, but I look at this chart. We could go up, we could go down, we could go sideways. And then when I go back to this chart, I'm sorry, wrong way. This is that long-term chart. I also could see we've put in a solid base here. We could climb out of this and put in some sort of substantial rally. There's a lot of factors going on outside of the lumber world that are definitely influencing us. So keep your eyes open to that. The banking situation has not culminated yet. One of the things I'm watching on that is if these banks that kind of failed, if they get sold. If they don't get sold, that tells me something about the banking industry. Keep an eye on what Warren Buffett says and does. If Warren Buffett's in buying, that's a signal that there's value there. Right now, I haven't figured out really if there's value in these banks that have failed. I read that the Credit Suisse, that UBS basically bought Credit Suisse for nothing. And the only reason they did it is because they got a big backstop from the Swiss government. So I guess my lean is a little bit nervous on the banks, and that could be our black swan going forward. So, all right, with that, everyone, have a great week, and we'll see you next week. Any questions, please feel free to reach out at any